Okay, welcome to our chapter 1. This is our second video in this chapter. We talk about the stockholder-debt holder conflict. The debt holders are holding the company's bonds and they receive fixed payments regardless of how the company is doing. On the other hand, the stockholders, they have the shares. So as the company does better, then they will benefit from this. So these different perspectives from two parties, this might lead to some conflicts. And these conflicts essentially arise in situations where the company needs to choose between various risky investments or projects. For example, in this table, we can see that the company has two alternative projects, let's say project L and H. And here, this is a hypothetical scenario where we assume the cash flow to the firm if the company invests into this project L, depending on those two states of the nature, either the conditions will be good or bad 1 year from now. So under the good scenario, and assuming that the money invested today, right, is given as $1,000 for the bondholder versus the stockholder. And as you can see, for the bondholder, they will get this 8% interest rate, fixed payment. Okay, so they will make this $80 at the end of 1 year. And their expected cash flow is just the same number, $1,080, let's say. And here the fixed interest rate is given by 8%. On the other hand, the stockholders' portion depends on whether the conditions are good or bad, because they are sharing the profit of the company or loss of the company. So if the conditions are good, then their investment will become 1,320, and if the conditions turn out to be bad, their investment decreases to 920. And assuming these two outcomes are equally likely, you can calculate this expected cash flow by multiplying these numbers by 1/2 and adding them together. So it's a weighted average that we get this expected cash flow. And under these two cases, based on the expected cash flow, the expected return for the stockholder is 12%. And suppose we have another project H, and in this project we can see, again, there are two states of the nature. I mean, depending on the market conditions, we might end up in the good scenario, good market condition, or bad market conditions. And suppose we still have the same 1,000 initial investment, and basically for the bondholder this time, if the conditions are bad, actually the company is losing everything and it's not able to pay back the bondholders' payments in the bad scenario. So then they will just receive $0. On the other hand, the stockholders' position, if things are good, they will get actually a much larger amount of $3,320. Their investment of 1,000 will become this $3,320. And again, in the bad scenario, they will also lose their investment. So in this case, the expected cash flows for the bondholder becomes 540, and expected cash flow for the stockholder is 1,660, and the expected return is 66%, which is quite high for the stockholders' portion. So from now, the stockholders might prefer project H because they have a much higher expected return from this investment. On the other hand, the bondholders, they are likely to prefer project L because they are just getting a fixed payment and they just want to make sure they receive this 8% return from their investment. Because as you see, for the bondholder, they might lose their initial investment if the company fails to pay back its borrowings. So this is explained also here. And as you see, the company has raised this $2,000 in capital, $1,000 from the bondholders, and $1,000 from the stockholders. And we assume that the interest rate is 8% for the bond. And the company's current plan is to use this initial capital of $2,000. And as you have seen in the previous table, for project L, this is a relatively low-risk project, and expected to be worth of $2,400 1 year from the investment. And it will be $2,000 if the market is in bad condition. So this is a low-risk project where the result is not changing dramatically, especially for the bondholder. That will be critical. And there is a 50% chance that the market will be in good condition, and 50% chance is going to be in the bad condition. And in either case, for the bondholder in the low-risk project, they are able to make this 8% return. And the stockholders will receive whatever is left over after the bondholders have been paid. So this is also important to know. Basically, the bondholders have the priority to receive their return, and after that, whatever is left from the profit, then that will be, of course, added to the stockholders' equity. So we compared this with another alternative project, which we call as project H here. Again, you can check the table. And this has considerably more risk. Project H has the same expected cash flow as project L. So notice that the expected cash flow is the same, but it will produce cash flows of 4,400 if the market is good, but 0 if the market is bad. So as you see, the range of the results is much larger. So it's definitely a bigger risk, and it's a riskier project compared to the previous one. So in this situation, the bondholder would not be interested in project H because there is a chance that they will not get any benefits from this investment, and they will lose everything if the market turns out to be in bad condition. So the bondholders understand that the managers and stockholders may have an incentive to shift to riskier projects, and recognizing this incentive, they will view the bonds as being riskier and will demand a higher rate of return. And in some cases, if the investors, especially the bond investors, if they think the potential risk is too large, then they might not prefer to invest in this company's bonds. So the managers need to convince the investors, the bond investors, that the company will not default. I mean, it will be able to continue to pay its obligations. So that will be the job of the managers for this company if they are issuing these bonds. Now, the next thing we will talk about is investing in socially responsible funds. In the recent years, there's a focus on the sustainable investments. Sustainability in finance is a hot topic, and you might see in many academic articles on this aspect as well. So the main principle is the companies should take some actions to make sure their operations are sustainable and in line with the principles of sustainability. On the other hand, investors also will prefer social responsible funds, and they will invest also in companies that oblige with these principles. So today, a large number of mutual funds or ETFs are basically following certain specified social goals, and they try to prioritize their investments accordingly. So these socially responsible funds applies different criteria, but in essence, typically they consider a company's environmental record, its commitment to social causes, and its employee relations. Many of these funds also avoid investments in companies that are involved with alcohol, tobacco, gambling, and nuclear power. And these investment performance varies among these funds from year to year. So here, as you see, just to emphasize, when we talk about the sustainability in general, there are actually three frontiers. One of them is environmental protection, related to preserving the environment and trying to reduce the pollution or carbon emissions or chemical pollutants. These are the environmental aspects of this sustainability issue. On the other hand, there is also the social aspect, social dimension. Again, you need to take actions towards the social causes, and the social causes are also diverse. You can think about, for example, men and women equality issues or poverty reduction. All these are potential social causes also for the companies and investors. And also valuing the employee of a company is important. Employee satisfaction is another important part of the sustainability, because if the company tries to be sustainable for the long term, then the company needs to make sure their employees are satisfied with their jobs, and all these social issues must be addressed by the company. So all these types of issues are part of the socially responsible investing idea. Okay, balancing shareholder interest and the interest of society, it's also important to keep this balance. We cannot just consider purely the shareholder interest, or the company, of course, will not purely focus on interest of the society, because it's trying to make a profit as well. So our course, we mainly focus on publicly owned companies, and their primary goal is the shareholder wealth maximization. At the same time, the managers know that this doesn't mean maximize shareholder value at all cost. Actually, just like we mentioned in the previous slide, it is no longer true that we can only focus on shareholder wealth maximization, but we should also consider the sustainability aspects, and the operations should be in line with environmental protection or social causes, and also employee satisfaction. So this means the managers of all the companies, and of course including the publicly owned companies, because they also need to fulfill more transparency requirements, they must follow the laws and other society-imposed constraints, and basically follow the principles of the sustainability as much as possible. You can think about various examples in this type of problem. For example, here there is Larry Jackson, who is the owner of a local sporting goods store, and Jackson is in business to make money, but he likes to play golf, let's say on Fridays. And he has a few employees who are no longer very productive, but he keeps them on the payroll because of their friendship and loyalty. So this is running the business in a way that's consistent with his own personal goals. But he could make more money if he didn't play golf or he replaced some of these unproductive employees with the new ones. But he is following his own personal, let's say, goals. So this will constitute a very simple example in this might occur in many circumstances in various companies, but this will obviously reduce also the shareholders' wealth maximization, and the shareholders will not benefit from this type of decision. So the business ethics also comes into play, and as a result of, especially in the recent several years, various financial scandals occurred. And this made regulators also and companies to think about business ethics more. So ethics is defined as a standards of conduct or moral behavior in the dictionary, basically. And a firm's commitment to business ethics can be measured by the tendency of its employees from top down with respect to their adherence to laws, regulations, and moral standards relating to product safety and quality, fair employment practices, fair marketing and selling practices, or confidential information, community involvement, and illegal payments to obtain business. All these together constitute components of the business ethics. So whether a company is following these principles or not, it can be identified from all these items. And if the practices are all in line with the principles of ethics, that company is also likely to benefit from ethical behavior in the long term. We can expect this will be also in the advantage of the company in the long term, because there is going to be customer loyalty, and as the company's reputation grows in terms of ethical and moral standards, this is also very likely to benefit the company in terms of repeated customer satisfaction and long-term loyalty. So basically, we provide an overview of financial management, and the primary goal should be to maximize the long-run value of the stock, and we emphasize that intrinsic value is measuring the true value of the stock of the company. And to maximize value, firms must develop products that consumers want, of course, and they should improve their production efficiency. And as we know, we are living in a competitive market, and the companies will compete with other players in the market. So they will need to keep their costs relatively low or in line with other competitors in the industry. And also they need to adhere and follow the social welfare and well-being of the people around them, and follow the environmental protection and regulations in line with the sustainability. And we also emphasized that businesses can be organized in different forms, like partnerships, or especially throughout our course, most of the issues that we will discuss are related to the limited liability companies, LLCs. But for like law firms, or like in the medical area, or law area, the partnerships, or the auditing area, partnerships, limited liability partnerships are also very common. But for most of our examples, we will talk about the limited liability companies. And finally, the primary tasks for the CFO, Central Financial Officer, because we will discuss a lot of issues related to the CFO and the financial aspects of the decisions. The CFO, we should understand the role of the CFO, what the CFO is responsible for. The CFO will make sure accounting system provides good numbers for internal decision making for investors. And basically, they will ensure that the firm is financed in a proper manner, evaluate operating units to make sure they are performing in the way it's expected, in an optimal way, and evaluate all proposed capital expenditures to make sure they will increase the firm's value. And basically, this is all for the overview, chapter 1. And thank you for watching. We will continue with the second chapter.